Welcome back. This is David Levenstein, executive producer at 1039 LA News Radio, and I'm speaking with Jan Tenhagen from the Tenhagen Financial Group, Tenhagen, Tenhagen Financial Group. He is the portfolio repairman, and the show's on every Saturday at 12:30. We were talking about the difference between tax and tax-deferred investing, IRAs versus Roth IRAs, 401ks. Some of them may have a Roth component within them, correct?
Yes, that's more and more prevalent now.
Right. So you have to check with your plan administrator, I guess, to see if that's available to you.
Right.
And if it is available to you, depending upon your tax bracket, you might qualify for that.
Very much so.
Right.
Yeah.
And now, what happens in the event you're saving for retirement, you have all your IRAs, you have your 401ks, and then you should get divorced?
Well, you're probably going to end up giving half of it away.
Right.
But it's on both sides.
It's on both sides, right.
Not just the one spouse, but both spouses.
You'll
split
it as marital assets, yeah.
Right.
You'll split that. And then you're starting over again, I guess. You know, I mean, your retirement's still going to cost you money.
Well, that's a good point, is to keep really good records of all your financial things, because if you develop a lot of wealth prior to the marriage, that's premarital. It's not included in the divorce decree.
Right.
So you got to document where these monies came from, et cetera. Then you document what it is that you had combined together with the marriage.
Right.
And that could save you a lot of aggravation and money.
I'm speaking with Jan Tenhagen from the Tenhagen Financial Group, in case you're first joining us. The Tenhagen Financial Group, you can find them at TENHAAGEN, Tenhagen.com. They're located in Huntington and Northport on Long Island, and they have an office in Manhattan. Jan Tenhagen is a certified financial planner. He has been working with clients for over 30 years, has seen his clients through many, many different market environments. Let me ask you a question. Though the market goes up and market goes down, the market environment changes.
Yes.
Should how people pay themselves change?
Only if they can put more away for themselves.
During the declines?
Oh, absolutely. Well, when the market goes down, there's a buying opportunity.
Right.
Everybody plays turtle and sticks their head in their shell. That's the time to look around and what did I really like when it cost $50, now it costs $25.
Well, that's very interesting because if someone's putting in 15% of their salary a week into their own personal retirement account, or 10%, right? So let's say someone takes home $1,000 a week, they put $100 a week in, argument's sake. When the market's down, that $100 is going to buy them an awful lot more.
Correct.
That's dollar cost averaging. Explain that to everybody.
Dollar cost averaging is putting a consistent amount into an investment on a timely basis. So let's say monthly, I'm putting $100 in.
Right.
So if, say, a stock is $10 a share, I put 100 in, I buy 10 shares. Well, if it goes down to 5, then I'm buying 20 shares.
Right.
And the markets historically go up, they go down, they go up, they go down, but over the long term, they go up.
But imagine you're $100 a share buying a stock at $100, $100 a month buying one share of a stock at $100, and then the market goes down 50%, and then that stock is worth $50. Now you're buying 2 shares. You're doubling your investment. I mean, the opportunity to put a steady amount of money into a fluctuating market can really offset some great returns for you, right?
Absolutely.
Yeah.
I mean, look at the market in all conditions. Don't look at it every day. You could drive yourself nuts.
Right.
But when we're near a high as we are now, well, look at what is it that I've gotten a really good profit on,
right?
And talk to your advisor as to, is it a good time to perhaps take some of that profit and put it into an area that hasn't come up yet?
Yeah, find some value.
Right.
Right. Yeah, is it hard to find value in an inflated market?
Well, in a high market, no.
Yeah.
No, because everything doesn't rise and fall like boats in a harbor.
Is it that 80-20 rule that really affects so many industries and so many aspects of life, where 20% of the stocks are responsible for 80% of the growth in the market? Seems to be that kind of follows us around, that 80-20 rule. Hard to say.
I'm not so sure about that.
Yeah.
No.
Yeah, I don't know. It just seems that there's always value to find. There are always some stocks out there that are hitting home runs that may be carrying the rest of the market. So there's always value to find.
Right. And the point you make about, okay, you've got a hot stock that went way, way up in your investment side.
Right.
Well, perhaps you take some of that profit and put it into an area, as I said, that has not moved yet.
Are people afraid to sell a stock that has done so wonderful for them? Like it's a stock that has just like doubled for them in the last few years, and like during that tech boom, the reason why people lost so much money is because they just didn't sell when they should have sold. They had these companies like Lucent or Sprint or things like that that just jumped up and like, oh, I'm not going to sell this. It's so high right now. I made so much money. I'm not going to sell it now.
Right, and unfortunately, people get tunnel visioned on it.
Right.
As I said before, I buy a stock, it goes up 50%, 100%. Mm-hmm. Well, let me take half of that out and put it into another investment I think has the potential going forward.
People are afraid to sell, though. And they're afraid to buy. They're afraid to step in.
Well, they're afraid of the market.
Right.
That's the problem. And they look near term because the media makes you look near term.
Right.
Look at the long term of the market.
So that's interesting. So what you're saying is people should pay more attention to their personal goals and less attention to what the market's doing.
The day-to-day market, there are many days somebody at the end of the day says, Jan, what did the market do today? I said, I have no idea.
Right.
And then I say, what's it going to tell you?
Yeah.
Nothing.
Right.
Nothing at all.
What does that have to do with what you need in your retirement, what it does today? Right. Because like you said, if you look at any chart, any Ibsen chart of the stock market, you see that it goes up over time. You take a really close look at it, and it's not without those ups and downs and those daily, weekly, monthly, yearly fluctuations.
Right. And I would suggest that people go online and look for the Ibsen chart.
Right.
And take a look at it.
Right.
And what you're going to see with that, and there's a Callahan chart that shows all the categories of investment in different colors.
And how they did during certain times.
Yeah. So a couple of years ago, real estate was at the bottom of the barrel, and now it's near the top. And
right.
It'll be in the middle. It'll be down.
So the Callahan chart shows you the different asset classes and which were the winners and losers of that particular year?
Correct.
Right. That's pretty interesting, right? I mean, everyone says real estate is a great investment, and it is a great investment because it's the only investment that you can park your body in and live in and have a cup of coffee in the morning. I'm not having a cup of coffee in my AT&T stock.
Yeah, but a house that you're buying to put the roof over your family's head is not an investment for future growth.
No, it's not.
It's your safety and your protection.
Right. I know that my parents, and again, it had to do with when they bought a house. My father spent $7,000 on a house. He put $7,000 on a $21,000 house down payment that he and my mom had saved for years and years and years. They sold that $21,000 house for $70,000, and they took that $70,000 and they bought a $70,000 house, and they ended up selling that for $300,000. And they took that money and they bought a $300,000 house that they ended up selling for $900,000. Not because they were so smart, because they rode that real estate train over the course of their life. But the most money that my father ever put down on a house, cash, was that $7,000 that he and my mom saved for the first 10 years of their marriage.
Sure.
That was it. They never put a penny out of their pocket after that.
And hopefully he kept records of new roofs and painting and repairs, because that reduces that cost even more.
He probably, knowing my dad, he probably didn't.
Right.
Like most people don't.
Correct.
But that's all he spent. Will my generation or my kids' generation ever get that lucky on that real estate inflation train?
Who knows?
I don't know. I can't imagine homes being more expensive than they are. But then again, I can't imagine the houses I grew up in being that expensive at all.
Well, if you look at the tech run, which was in the 90s.
Right.
And in 2001, it collapsed totally. But real estate was going nuts, too.
Right.
And I know so many people that, no, get my money out of the market. I'm going to buy this house, fix it up, flip it, buy it, flip it.
Right.
Well, guess what? The last one didn't flip so well because everything tanked.
Well, that's so interesting, right? Because people went from the stock market, they sold out, they made some good money, they bought real estate, and the real estate market crashed as well. And I know people that lost money back to back in the stock market and real estate and had to start over again.
And that's why you diversify.
That's why you diversify. That's why you have a plan and set goals.
Exactly.
And start young.
Well, that's a good point.
Start young.
A lady friend of mine, a good number of years ago, when you could put $2,000 into an IRA.
Right.
Her daughter was just graduating college, getting a very nice job.
Right.
And we talked her into putting the $2,000 a year away.
Yeah.
And back then it was 8% return.
Okay.
We figured by the time from 18 to 65, she'd have over $1 million in that plan.
From $2,000 a year
Right.
at an 8% return.
Right.
Now you may be a little conservative, but you can put away more.
You can put away more. Interest rates are lower. The markets have still, over the longer period, averaged 10.25%.
Right. I mean, so starting young. So if you're listening and you have a son or a daughter who are 18 years old, urge them to call Jan and open up an IRA for yourself. Get some good, solid investments that have been around for a long time. Let Jan help you pick those out, and start now. So that way you're not struggling to start later. Just start now, a little bit now.
Exactly.
It's amazing how time in the market versus any other aspect of investing really bears the greatest fruit, right?
Time in the market wins. Timing the market does not.
Always wins. So time in the market. So if you're 18, 19 years old and you're listening, go to Haagen Financial Group. That's Haagen, Ten, Haagen, Ten. He will see you through the market. He'll design a portfolio for you that will suit your lifestyle, your risk tolerance, and your time horizon. This is David Levinstein speaking with the portfolio repairman, Jan Haagen. We'll see you next week.